Great. Listen, Dan, it only took us 130 episodes later to have you back. So you were episode number 2. And funny enough, it was an early episode when we were just kind of, basically I was like, oh, let me have conversation with people in my network about topics that I think are interesting for founders. That's how it started. And you were, after Nico Sakazi from Kazakh, you were on episode 2. And we talked about, Cayman structures and offshore. A lot has changed since we started at Latitude. And so welcome back to another episode here. And it's great to have you.
Yeah, thanks, Brian. A lot has changed. It feels like that was, a decade or more ago in terms of where we are, the fundraising cycle and what Latitude has built and, market interest and the ups and the downs. The beauty of it is, and you know this well, because you've been in Latam for many, many years and I have as well. Markets have ups and downs. Markets like Latam have even higher ups and higher downs. And we've all been through this before. The thesis remains the same, which is building interesting tech-enabled companies to disrupt markets. That's not going to change. So happy to be back.
No, it's awesome. It is like dog years and startup years, right? Like the kind of 7-to-1 ratio is definitely, we're still a kid, but we're like kind of not a baby anymore, like, kind of entering into teenage, years here. But yeah, things change fast. And so it's great to have you back. Look, I think that a great topic for us to dive into, the funding environment has changed a lot. 2021 was a bit of an anomaly. We saw crazy activity, even at the beginning of 2022. Things are different right now. And this new environment, I want to translate some of this stuff for the founders on how it impacts the legal pitfalls also, because there's a lot of things that people don't talk about that surface. And one of our objectives at Latitude is to try to give more insight into how to navigate these things as a founder. And I know at Gunderson, you guys believe a lot in giving back. You've been, active mentors in the community and surfaced a lot of knowledge for the region. So maybe we can dive into that as a more verticalized kind of focus today. And of course, if there's other tangential opportunities, we can address those too. But how does that sound?
That sounds great. I mean, I think it's clear where we stand today coming into the end of the first quarter of 23 that the market challenges that we saw start last year are here to stay in terms of, fewer late stage deal activity, valuations getting compressed, fewer international investors, particularly at the growth equity stage, active in LATAM at the moment. IPO markets remaining effectively closed for most companies. And M&A, which we can talk about, kind of being a little bit episodic. But those market challenges that started last year, I think, are going to remain for the foreseeable future this year. And it means opportunities and challenges for companies that are out there that are trying to fundraise or that are trying to grow, and all sorts of interesting legal topics that we can riff on today.
That's great. Yeah, let's start with a little macro. I definitely have seen the global investors kind of, particularly at the growth stage, back off and kind of not be as active as they were. Are you still seeing some of the international investors active in earlier stage? And give me the overview of how you see kind of the different stages of kind of seed, A, B. Where's the impact primarily, and how do you kind of anticipate things shaping up in 2023?
Yeah, I think you're right. The greatest impact of the slowdown right now is felt in the growth equity stages. We're not seeing the $50 to $100 million plus Series C rounds happening at the velocity that were happening, 18 months ago. And I think that is going to remain the case. There's a lot of wait and see attitude among investors like Tiger and Bike King and Green Oaks and others that are out there. That said, on the early stage side, seed, pre-seed, even Series A, it's still pretty robust. We're seeing a pretty good pipeline of activity. And those investors and those companies have the luxury of having a much longer time window, 7+ years out to liquidity. So you're willing to take more of a risk. You're willing to lean in. Valuations have changed, but deal activity is still pretty robust. And where we are today versus, call it 5 years ago, we're still light years ahead of where we were in 2018 in terms of the depth of the market. in terms of the local investors in Latam who are super active, as well as the international investors that are active. Let's take Lightspeed, right? They just did an early stage deal in Vexi. They're sitting on, I think it's $7 billion of new funds that they raised mid 2022. And they barely started to deploy that capital. And so you're going to see a lot of deal activity in months and years to come, particularly in the early stage.
Yeah, I caught up with Pamela over at Beak, and they just raised a Series A from Lightspeed, and I think Mercedes led that. And yes, there's there's despite them being such a large fund, and there's a handful of others that have a lot of dry powder. I think they're going a little bit earlier, and I think that's great for the Latitude community, for early stage founders. There is a fair amount of dry powder accumulated. I think that's the conversation, is like, how long are investors going to sit on that? When is the deployment cycle? What does it look like? But we'll see how that goes. But let's talk more about nuts and bolts around term sheets. What are things that you're seeing that maybe you didn't see in the past, and how can founders prepare for and weigh these new conditions so they're effective?
Yeah. So we're seeing, the pendulum shifts in environments like this. And so the pendulum has shifted back towards investors who have leverage, who have more of an ability to either sit back and wait until a company gets traction, then put forward a term sheet. There's not as much scarcity value. And so that translates into term sheets that are more investor friendly. And that can take a variety of different forms. It can take the form of protecting the investor on the downside. In a priced round, that means a multiple on the liquidation preference. So just yesterday, I saw a term sheet with a 3x liquidation preference, which in 2021, you would have never seen, or it would have been sort of laughed at. This company, given the challenges that it has, is entertaining that term sheet because it has to in that environment. And so you see, investors taking advantage of protecting themselves more on the downside because they can see more existential risk for their portfolio companies. They're taking, maybe a more aggressive view on governance controls, on board seats, maybe, offering 2 seats for an investor position rather than 1 seat, for an earlier stage deal. And you're seeing valuations compress as well. My general principle in guiding companies is, particularly for the early stage, if you are quite certain you're going to raise again, you really need to think long and hard about setting a precedent that's going to hurt the company in the future. I'd rather have a company be honest with itself about valuation and just sort of take a lower valuation with a clean term sheet than try to do something unnatural and aim for a higher a higher valuation or a flat valuation. So we can call it a flat deal, but with additional structure that the investor needs to make their economics work. Structure being a 3x liquidation preference as an example. Why? Because the 3x, if you have that in a Series A deal and you have to just swallow it and agree to it, well, guess what? In your Series B deal, even if you're doing super well and 18 months from now and the market has changed, your Series B lead investor is going to see that 3x and be like, hey, I want the same. And I've seen this movie over and over. It's really hard to claw out of that as a company, even if you're just crushing it, because you've already opened the gate to that 3x. As opposed to, swallowing hard, maybe taking more dilution and a lower valuation, but then growing into that higher valuation with clean terms.
Founders don't realize that they're setting a template, right, for the future. And like you said, you're never taking away. You're always either going in with what exists or adding to it. And so, you're really setting a precedent if you accept those things. And it's funny because I remember as a founder really struggling with the concept of, I remember getting a term sheet from GA and it was a down round. And I was like, I don't want to take a down round. It was like, I kind of like took it personally. And it's like, look, you need the capital you need to execute the stage of your business. And founders forget all the time that publicly traded companies go up and down all the time. And there's this mentality where it's like, it can't, change. It has to go up and to the right forever. And which is not realistic. And I think that you're shooting yourself in your foot if you're trying to save face. And by doing that and getting a flat round or even a step up in price, but having these egregious terms, like you're really creating a poor foundation for the future.
You're absolutely right. And so you're starting to see some normalization in valuations, and you're starting to see that founder mindset shift. It takes time. It's always an evolution, but you're now seeing companies take valuations in some cases that were a third or 40% of what their last round was. And yet they're calling it a victory because they're staving off, the greater existential risk that is out there. And they're building, into a broader cap table with newer investors. And there's things as a founder and a management team that you can do to kind of help partially offset the dilution from a down round, right? So it's not uncommon to do an ESOP refresh, a pool refresh that helps partly offset the dilution with a significant slug allocated to the CEO or founder or key employees, and then others for new hires. Like that's something that investors generally like, and it resonates with them because they're building that alignment of interest and they're continuing to expand the ownership model. So don't feel as a founder that you're just, over a barrel and that's all you can do is take a big down round. There's things that you can help adjust to offset the dilution, but better to do that than insert a bunch of crazy investor friendly terms that add the structure that hurt you down the road.
At Viva Real, I was able to negotiate. We suffered pretty massive dilution because there wasn't much of a venture capital ecosystem, and we raised some capital, and I got my equity came down quite a bit. And as CEO, I think that one, for the founders listening, you shouldn't approach your board and being like, "Oh, I've been too diluted, and I need some more equity." What you should really emphasize and position is like, "Hey, I'm executing really well now, and I would like to earn some more equity." And that's just a kind of a strategic advice to founders, rather than kind of playing the victim of like I've gotten diluted, and rather like, hey, I'm delivering outsized value and I want some more upside. So just as like a tactical advice to founders listening, but it's common. I've helped a bunch of founders renegotiate back a little bit of equity, and investors want you to be motivated and they want to reward high performing founding teams and CEOs. So it's definitely not unheard of, and it's not the end of the world if you're diluted. There's ways to kind of, as you said, compensate for that.
And sometimes in environments like this, it's often the case that a milestone-based vesting grant, where it's, concrete and it can be measured, but it's tied to a specific commercial objective, new client intake, big commercial deal signed, new market expansion, whatever it is that can be measured. Maybe it's an offset, maybe it's a refresh grant that's tied to that specific milestone rather than just the straight time-based vesting, which we all love because it's easy to measure. But in environments like this, where you're trying to grab a little bit more of a refresh mentality, I think that milestone-based vesting can work well, and investors generally like it.
Yeah, I think it makes a ton of sense. Yeah, I mean, beyond the term sheet, there's a handful of other topics that we can discuss around things like bridge rounds and other mechanisms to finance. First of all, from the standpoint of financing the business, if you can get prepaid revenue up from your customers, those are great ways to try to prepaid contracts. But how are you seeing? I guess before we dive into kind of extension rounds or bridge rounds, as you call them. By the way, I don't like to call them bridge rounds because it always sends this like signal like that, like things aren't going well. And it's like the bridge. Yeah. It's like, like the bridge is collapsing and has this different visual in my mind. So I always recall them as like, you can call it an extension or like we're opening up a little bit more. The nuance of these kind of communications, like in the mind of whether investors like to admit it or not, they're affected by the terms of how things are. What are your thoughts on what are you seeing in terms of founders, getting additional equity? Are you seeing if it's an A round, or like a post A or a post seed, are you seeing safes be attached? And what are the implications for founders and what are things that they should be kind of keeping in mind?
Yeah. So we're seeing a lot more variation in the market today. There's a lot of tools that are available to founders out there. 10 years ago, it was just convertible notes and priced equity. So today, we are seeing a lot more. We're seeing a ton of safes to begin with. We're seeing safes at the pre-seed round, right before priced round. We're also seeing safes in those interim financing rounds that, some would call a bridge and others would call, that extension where it's, maybe it's a valuation cap that is a modest uptake on the prior round or something that's, fairly neutral, but it's enough to get the company some additional cash to get to that next price-based milestone where they can raise that round and call it 18 months. We're seeing a lot of companies just focus on weathering the storm right now with the expectation that next year is going to be a more vibrant fundraising market. And so they're doing a safe, they're doing a modest safe. It's just as little as needed to kind of get you to that next commercial milestone. With typically a valuation cap that is more modest than it would have been a year ago, but something they can live with. And from a legal perspective, that's great because it's an easy round to execute. We all know safes, there's not too many things to negotiate. You got to be careful though with giving out, MFNs and side letters that give pro rata rights to, not only your major investors, but a bunch of smaller checks, board observer seats, things that wouldn't be natural in a safe round that would be more typical of a priced round. You got to be careful that you be sort of stingy as a founder in giving those things out. But otherwise, safes work super well in that environment. And we're seeing a ton of that. We are also seeing, and I think we should talk about debt, right? Good old fashioned non-dilutive debt, which 5 or 10 years ago was super scarce in Latin America. And the great thing is now you've got a number of new players that are in the debt space. Particularly great when you've raised that equity round, you've raised a priced equity round with a VC, call it, 6-9 months ago. The debt provider loves that environment because they can lend to the balance sheet and they know the investor, et cetera. So there's a large number of debt players out there. Now, not every business is suitable for debt, right? But a lot of businesses are, particularly the fintech businesses we've seen. So, WTI and Architect and Partners for Growth and even SVB itself and a bunch of other players are out there and active and like Latin America. So that's something to be considered.
Yeah, that was unheard of 10 years ago. There was just no debt partners. And I want to go back to the safe for a second because a couple of years ago, the YC safe was, has been popularized and it's, kind of the go-to instrument or document that it's used to raise capital, particularly at pre-seed and seed. YC flipped their post-money or pre-money to a post-money valuation. And I think that's I don't think people realize the impact of that. I've seen founders that have stacked up a bunch of post-money. Can you talk through the implications for dilution for founders when they stack a bunch of post-money safes on top of each other versus a pre-money safe? I don't think founders do the math oftentimes.
They don't do the math oftentimes, and it can be very dangerous to stack post-money safes on top of each other because every dollar that is added to that additional target on the post-money safe is directly dilutive to the founder and the team that is on the cap table before that safe, as opposed to the pre-money safe where it's the shared dilution across everyone. So you've got to be strict about doing the post-money safe. And if you're targeting $1 million raise, end up at $1 million. Don't layer on an additional $1 million to get to $2 million unless you're comfortable swallowing that dilution, that additional $1 million dilution, which will go directly to dilute you as the founder and the rest of the team. So it's a subtle difference, but it's one that affects the founding team more than anyone else in this environment. So, but the reality is today, pre-money safes, when YC made that change a number of years ago, they shifted the market. And so most things today are post-money safes. So you got to understand what that means. It's always a good idea, and you guys do this, and we all help companies model out expected dilution, do a pro forma cap table. Doesn't have to be super sophisticated. Ask your lawyer to help you with that. Work through Excel and work through some assumptions. Like, this is what we think we're going to raise in the price round when everything converts. This is what we think we're going to need from an ESOP perspective. This is what our safe terms are. Just so you're not surprised, because we see it over and over again where, you thought you were taking 15% dilution and you did the post-money safe and you stacked on a couple of additional ones, and then suddenly you're taking 30% dilution.
Yeah, I think that is something that needs to be modeled out, and it's not obvious. And founders are like, "Oh, I'll take another, another slug of 500K or $1 million." And given that you've got these post-money, safes already stacked up, like you said, the dilution goes directly to you as the founder, and it doesn't dilute the other safes that have been out there. And so I think that math is significant. And just for the audience that's not familiar, you mentioned MFN, that's most favorable nation clause, which basically gives the investor the right to invest at the next, matching the same valuation of the next investor. So it's basically like it's a right to be able to put more capital into the business. That's something that you got to be careful, because you're kind of stacking up a bunch of commitments of future money. And I think the implication of that sometimes are, if you don't get the right pricing on the next round and there's already a right to invest a certain amount of money, again, increased dilution. Some of these things are at the margin. If you're just trying to survive, is not the end of the world, because you sometimes just need the money. But these, I think that founders don't understand all the time the implications of all this stuff.
Yeah, absolutely. And that's why, folks like Latitude and Gunderson and others that are helping democratize this information, that's the role that we play. And make sure you've got good advisors and good counsel.
How are you seeing valuations? You'd mentioned that there's an adjustment in valuation. Let's talk about the different stages. If you could, I won't hold you to it, the exact numbers, but I know that you guys see so many deals because you guys represent a lot of companies at across the spectrum of, from seed to Series C and beyond. What are you seeing? If you were to kind of like give us the back of the envelope math on the price adjustments at C, B, let's go down the alphabet, and then go to the seed. What are you seeing?
So I think we're easily seeing 30 to 40% decreases in valuations across the board. So in some cases more. So, for a seed deal, pre-money priced round today in Latam for a solid company, anywhere between, call it, 5 million pre to 12 to 15 million. That is significantly lower than 21, when we saw, healthy pre-seed or seed pre-money valuations above 15 million, in many cases. And so, but that's not a bad thing. That's a normalized thing. That's kind of where the market was before the market blew up during COVID. So we've sort of come back to earth from that valuation perspective. A rounds, could be all over the map, but anywhere between, call it, pre-money of 20 up to pre-money of 80. Whereas in the heights of 21, you'd see pre-money north of 100 million at times, crazy valuations. And I think when I talk to US and international investors that look at LATAM, they are the first to sort of say, look, things got out of, we collectively as an ecosystem kind of got over our skis on valuations. There was such euphoria. And they think that it is now much healthier from a valuation perspective, much more attractive. So my sense is that that's going to draw back some investors. You talked about the dry capital, the dry powder that's out there. I think that's going to draw people back into the market as valuations adjust. Series B, can be anywhere from pre-money of 50 to pre-money of 150, 200, sometimes more. We're seeing much fewer at the Series C and B rounds. I've now seen 3 of these deals from an investor that you would know, Brian, that's an active LATAM investor, has been for decades. They're doing deals in first time of companies that have never raised institutional capital, that have been around for 10 or 15 years, that have bootstrapped into something interesting. And they'll do what's called a Series A deal. It'll be maybe 20 or 30 million on pre-money of 80. And it's interesting. I've seen three of those deals in the last 6 months, but those were fairly uncommon. See, what I think is happening is you've got players out there that have, reached a conclusion that they need to raise venture capital. Yeah, maybe the terms aren't as great as they were 18 months ago, but they're still pretty good from a historic perspective. And then they want to lean in with the right investor.
Yeah, that's interesting to see. I think that there is a tendency to find those kind of more solid companies that have been bootstrapped for a long time, that have had to be financially resourceful, and they've got good kind of bones and DNA because they never took outside capital and they had a lot of operating discipline, and they've got some fundamentals, but they want to kind of swing for the fences more, and so they bring on a capital partner that can kind of help them accelerate, and they have good unit economics already. I think that's an interesting model, and sounds like a great opportunity for investors to identify those companies and kind of elevate them.
Yeah, it's a flight to safety, as you're sort of alluding to. From the investor standpoint, it's a much easier thesis to understand when they've got good unit economics and they've got a long track record, as opposed to funding something with a pitch, a PowerPoint, and two guys in a garage.
Absolutely, yeah. One other question on just talking a little bit more about, we've covered the different rounds from pre-seed to kind of growth capital. Are you seeing any secondary transactions happen, or is that slowed down? I mean, there was a little bit of secondary over the last couple of years, not a ton. Are any secondary deals getting done? And then what are discounts that you're seeing on pref?
Yeah, we're seeing far fewer secondaries. We're not seeing the splashy, later stage round coupled with the founding team selling out a piece of their stake or something like that. We are seeing a little bit of secondary activity from early investors that just want to take maybe they want to take a capital loss for various reasons, and so they're willing to sell out a piece at a steep discount, right? So we're seeing some discounts on the pref that are in some cases up to 75% of what you would have seen in the prior round. So and those are motivated by maybe VCs that are long in the tooth, VCs that want to take a capital loss, VCs that want to reallocate capital in different ways, but nothing like the environment we saw in 21 when there was a lot of secondary activity. And so I think that's going to remain pretty low level. We are occasionally, I'm actually doing this right now, a founder is converting their FF and selling a piece of that as part of the new round that they're raising, because that founder needs some capital. But that's kind of more at the margins.
And how would we know the IPO markets are pretty much kind of closed, and we're not going to see a lot of activity there. I mean, maybe there'll be occasional opportunity there, but very few and far between. What are you seeing in terms of M&A? Kind of the famous Arrington Senna quote of when it's raining on the track, you can pass 15 cars, and when it's a sunny day, it's not happening. Are we seeing any M&A activity, acqui-hires? I know that at Gunderson, you guys have a team that focuses on M&A, and I know that's not your focus, but you represent a lot of startups. You have your finger on the pulse of whether that's the more established startup that's scaled or the earlier stage startup that might be picked off by a larger incumbent. What are your thoughts on that, and what's the activity look like?
We're seeing far more buy-side M&A than ever before for the reasons you mentioned. I think that well-funded company that was fortunate to raise in 21 or the first part of last year is sitting on a lot of capital. They don't have the need to go out and fundraise given, the challenging market, but they have seen valuations decrease. They've seen the same talent out there looking to find a home for their technology. And so, literally every week I hear boards talking about opportunities for tuck-in acquisitions, buy-side acquisitions, distressed companies that have great team, great founding DNA and technology that maybe hasn't yet found the right home, but that they can park it. So I think you're going to see a rash of buy side M&A among the large companies out there, buying, the pre-seed company that wasn't able to fundraise or just got caught with the wrong timing for fundraising. We've already started to see some of that. We're going to see a lot more of that to come. That is the legacy of these large growth equity rounds that really never happened in LATAM prior to 2019 or 2020. So you've got companies that are able to weather a long winter, right? Cash to last the next 4 or 5 years. And you've got cash and equity to deploy on the buy side and consolidate. So I think that's actually a really healthy trend for all parties, because the small company that's able to sell, maybe they don't realize the economic gain that they were hoping for, but they're able to call it a victory because they were able to exit and they're able to join, a great founding team with the bigger company, build something bigger, and then maybe they go off and start their next thing, and they've learned a lot from that environment. The diaspora of folks is going to grow like that, and the training grounds in Nubank, and in Kavak, and in all these other companies for small founders to learn from. It's going to be a great training ground. It's a super hands-on environment.
Yeah, I think Hitching Your Wagons is another company that's kind of, on the rise and is well capitalized. What people don't realize, in the Silicon Valley, a lot of wealth was created by those founders that sold their company. I mean, I know my buddy Sam Lessin sold his company to Facebook in the early days, and which was kind of a Dropbox before Dropbox, and latch onto a rocket ship or the future new banks of the region and be part of that story. Like there's a lot of value that's going to be created there as well. And so I think that's an interesting, and it's interesting to hear that there's on the, more on the buy side. Listen, I want to wrap up here. This has been great. We've covered a lot, like in a very compact episode here, from pitfalls for founders, fundraising in this environment, what to look out for, trends around, pre-seed all the way to, growth equity. Maybe wrap it up here with some advice, on a practical note here. Founders in Latin America that are currently thinking about how to best fundraise in the current environment, what can they make sure they get right to have the best possible terms? What is just a non-negotiable thing that, you just don't want to, you want to fight tooth and nail to hold on to? What are some things that you think founders maybe obsess about? Talked about the valuation piece and the potential down round. Maybe besides that, what are the things that maybe people over obsess about that is not that big of a deal? So if you could give us some practical thoughts on the way out here, would love to hear from you.
Yeah, I mean, I'm one, when I'm counseling companies, to obsess around the board, because the board controls the company, and so and in the early stage, the alignment should be largely with management running the day-to-day and running the board. So do not give up board control at a Series C or Series A deal. That's kind of non-negotiable, right? Even in this environment, unless you're, literally existential risk is on the line. I think you shouldn't obsess as much about valuation. We've talked about that. You should think creatively about the investor pool that you're targeting. So the beauty of today in 23 is there's a much broader investor market out there. We talked about debt. We've talked about, the vibrant local investors that are out there running around with new capital in some cases. Looking like Dila in Mexico has capital to deploy. All VPs raising a new fund, like great local investors that know the market as well. So tap into those, tap into the super angel networks that Brian, that you're part of. Tap into the international investors that are looking at the region strategically, beyond Silicon Valley. I'm thinking, some European investors. I'm thinking even the Middle East, right? As the Middle East gets more diversified with their economy, they're starting to look more at Latin America, particularly like on the climate side, et cetera. So be creative around investor pool. Don't obsess around valuation. Do obsess around kind of being in the driver's seat from a control and a board perspective, and be patient because it takes time. There's no longer that scarcity like, oh, I got to drop a term sheet or I'm going to lose it tomorrow. Investors are sitting back in the driver's seat. And so you as a founder there has to be a forcing function. And the forcing function needs to be like, I've built something cool and amazing. And, I'm talking to you because I think you're the right person, but I'm going to talk to somebody else. Like at the end of the day, it comes down to the quality of the team and what you've built, and continue to obsess around that.
I think that's great advice to wrap up here. And yeah, Dan, thanks a lot for coming back. I think what we should do is there's a bunch of topics around, things that you've seen. You're so close to all this stuff with the different startups that, maybe we'll try to have you back a little more regularly and kind of go deeper on specific topics that are relevant and current for founders. And so thanks again for coming back. I've only had a few repeat people on this podcast. So thank you for making the time and sharing your experience with everybody. And I appreciate all the partnership with Gunderson over the years.
Thank you so much, Brian. Always a pleasure to chat. Take care.